G'day everyone and welcome back to this Hidden Gems webinar series. Thank you for your time. Okay, so what did we see this week? What really stood out, we thought, was the strategic investment by Phillips 66, which is a spin-off out of the oil and gas giant ConocoPhillips, and it took a $150 million equity position in the EV battery player Novonix, which is listed in Australia. So what the market is witnessing is kind of the evolution of the oil and gas players into cleaner energy as they look to diversify their business models. Now, in talking with our oil and gas analyst the other day, he highlighted how cheap Woodside was relative to the oil price, about as cheap as he's ever seen in his decades of analysing the company. Of course, the real issue is that ESG-focused investors generally can't invest in oil and gas sectors anymore, which means these sort of companies may trade cheaply for the time being. So at the board level and with the oil price surging, companies like the $35 billion ConocoPhillips can afford to make strategic investments in an effort to diversify, but also to add value to their shareholders and ultimately their share price via these strategic investments. So it's going to be really interesting to watch these industries moving forward as supportive market fundamentals promote strong balance sheets, enabling companies really to address two questions. And the first one is, do they make strategic positions to pivot their business models like ConocoPhillips did with Novonix, or do they consolidate, accept the changing dynamics of their industry, capitalise on cheap valuations, make acquisitions, and become the dominant player in the market? So only time will tell, but it's happening right now, and that's one of the themes emerging in the markets. Okay, so let's make a start. Enough of the intro for me. If you want to ask a question, type it in the box provided. All these webinars will be on the YouTube channel next week. First up, we have Genetic Signatures, ASX code GSS, market cap 185 million. We welcome back John Melky, who's the CEO and director. The company is a specialist molecular diagnostics company focused on the development and commercialization of its proprietary platform technology. John, over to you.
Thanks so much, Tim. Pleasure to be back. I'll launch straight into our executive summary. There it is. Genetic Signatures is not a new company. In fact, we're a 20-year-old company. We have origins within CSIRO. We have been listed for 6.5 years, in which time we've continued to develop and commercialize, as you said, our unique nucleic acid technology, which we call 3-base. And 3-base was developed as a way to simplify the detection of infectious diseases. So these are the microorganisms that make us sick. Some of them, as we know, have a very high mortality rate. So the 3-base platform allows us to design and develop, manufacture, sell, support kits to pathology labs. They're our customers, and they use these kits on patient samples. The tests that we make are molecular tests, PCR tests, which directly detect the genetic information. This is what they're referring to as the gold standard of test with COVID testing. But importantly, our 3-base technology is less susceptible to mutations that happen every day, particularly in viruses. And we have therefore patented our 3-base method and the workflows, and expiry dates are now out to 2031 and even beyond. So while we have application in infectious diseases, it is a core technology and does have application to cancer screening and epigenetics, but we are focused on infectious diseases and have been selling those kits for the last 7 to 8 years. We've certainly seen year-on-year growth during that time, 4-year CAGR of about 93%. And sales revenue of the year that we just closed increasing 151% over the prior year. Importantly, we've quadrupled the number of Genetic Signatures branded instruments that we have in the field over the last 18 months. And we have customers using our tests every single day in Australia, Europe, and the US. It's a fairly straightforward sales model. We sell our kits to testing labs. They use the kits every day on patient material. They pay us on standard 30-day terms. So it's really quick time from sale to cash. And the lab itself is reimbursed through government subsidies. Once our customers establish a workflow, It's really more like a printer ink cartridge model. So we sell them our tests as consumables to use on their instruments. And we've worked very hard to make sure that all of our tests work exactly the same way. So our customers, existing customers, can easily integrate new tests as we bring them onto the market. And we already have multiple regulatory registrations in multiple jurisdictions. Multiple kits registered in Australia and in Europe. And in the US, we have an exemption which allows us to sell our SARS-CoV-2 test for the virus that causes COVID-19. And we're also on our way with our clinical trial for our first FDA product. So as we're now established in use every day in Australia, Europe, and the US, on the next slide, I can confidently say that 3Base is now a trusted and proven technology. The tests we produce are syndromic panels, and all that means is that we can test for a really broad number of infectious agents on the one patient samples. So, for example, somebody presents with respiratory symptoms, sore throat, runny nose. They may have influenza, it might be rhinovirus, could be RSV, could be a mild corona, or in fact could be COVID-19. And our tests are able to look for all of these and more in the one patient sample. So on the right-hand side of that slide, you can see the upper part of the kits that we sell, and on the bottom of the genetic signatures branded instruments that we sell. But because of the power of our technology, 3Base, we can detect every known variant of SARS-CoV-2. The next slide will show you how we are able to achieve that, and it is via that unique 3Base technology. So we do convert all of the C letters in DNA to a T letter, and that is the reason that 3Base is resistant to most genetic mutations, because it's that C letter that's the most unstable letter in DNA, and it does spontaneously convert to that C letter. So we know that that's happening every day, but those are invisible to our technology. So as a consequence, genetic signatures is able to detect every known variant of SARS-CoV-2. 99% of them are a perfect match. And that includes alpha, beta, gamma, delta strains that are becoming quite commonly talked about. So the next slide will really highlight the busy 12 months that we've had. The 12 months are really significant in terms of the record revenue that we have recorded, starting last September, where revenues were up 585% on that prior period. December also up 744%. We also announced back in December our first US-based routine customer for our SARS-CoV-2 detection kit, which was very significant for us as the US is a target market. We received CE-IVD registration for our sexually transmitted infection detection kit. And in April, we announced that Dr. Neil Gunn joined our board. And Dr. Gunn was previously the president of Roche Sequencing Solutions. And prior to that, he was the vice president of Roche Molecular. So more recently, given year end, we announced our annual revenue was up 151%. And we also announced at that time that our monthly revenue for July, the month just closed, was in excess of $4 million. We also announced we're developing new kits, which is for vaccine preventable infections, as well as for tick-borne infections like Lyme disease and dermatophytes, which are fungal infections of skin and nails. So the next slide graphs the annual and quarterly revenue that we've received over just the last 4 years. It's very easy to see graphically that 2.5-fold increase in annual revenue compared to the prior year, and that 4-year CAGR of 93%. But importantly, as we're focused on taking our technology globally, international revenue was 21% of our total revenue, and that really reflects the inroads that we've made into our offshore target markets. Certainly demand for our products remains strong, and that's the reason why we disclosed that we had already achieved 4 million plus revenue for the month of July. So the significance of that can be seen here in this graph, where that 4 million historically was our 5th biggest quarter, and that we were able to achieve almost that just in the month of July alone. So we're certainly very well positioned to leverage the gains that we've made over the last 12 months with the number of genetic signatures instruments increasing, quadrupling since the start of the pandemic. And it's these instruments that continue to generate us revenue. We have registered tests, so regulatory approval tests that we can add into a lab's testing regime at the appropriate time. So in terms of cash, we had a positive cash flow for 3.7 million in financial 21 compared to a net outflow of 9.5 million in financial year 20, and close the year with 30 million in cash, allowing us to continue executing our expansion plans with a great deal of confidence. So on the next slide, I'll take you through our strategy. We are certainly focused on the 3 regions of North America, Europe, and Australia. I'll take you through briefly each region. So the US, we are direct sales and support staff, and we have a distributor in Canada. We already have that US market entry that I spoke about with our COVID detection kit, but I'm also very excited about our preparation for our enteric protozoan FDA product, where we're aspiring to win up to 40% of market share in the next 3 to 5 years. We've made good inroads into Europe over the last 12 months. It was often difficult circumstances, but we have direct sales and support teams in the UK and in Germany, and we've developed a good pipeline of opportunities there. We do have distributors in other key countries, and we have a number of sites that are using us just for COVID screening, but we have those other kits ready with approvals that we're free to market. So we've actually just finished an enteric trial, for example, in Europe. Australia, being our home base, is where we're direct with sales and support. We manufacture all of our products. We have good penetration in New South Wales and Victoria. Recently announced that we have a new customer a new lab up in Queensland. And that's really significant to me because Australia is regarded as the most competitive market in the world. It's lean, it's efficient, and very well respected market. So doing well here is certainly a very good point from which to take your technology globally. So on the next slide, I just wanted to show you the potential of that one product. This is a product that detects enteric protozoan infections. And we believe that this product will displace traditional tests for parasites because that's looking down a microscope. And very briefly, it's been estimated that there are about 5.5 million of these traditional tests performed in the US each year. We're aspiring to win up to 40% of that market. And while pricing is still to be set, you can see on that table in the bottom left there what sales might look like if we were to win between 20 and 40% of market share with sales between 20 and 40 US dollars. So that single product only could generate 22 to 88 million US dollars in revenue, annual revenue. And it's for that reason that we're obviously very excited to finish our trials and submit our FDA application. So even though that's just one product, the next slide shows you the product range that we have commercialized and already in development. Now, the important thing here is that it's the top 2 products, respiratory, fueled by the pandemic, gastrointestinal or enteric infections, which is our most mature product. So they are the majority of our revenue for those reasons. But this slide is to show you we have 7 additional products, some with regulatory registrations and some coming through the development pathway. So when you remember that these tests work in exactly the same way with compatible instruments that are already in the field, I think you can see why we're very excited to complete development and commercialize those additional products. So I'll just finish up on the next slide by looking forward. I think it's quite clear now that we have multiple growth opportunities in front of us. We're certainly focused on 3 things. The first is continuing to secure those long-term customer contracts. These are high throughput, high value contracts. Secondly, we're focused on upselling to the new customers that we've gained over the last 18 months, remembering our tests all work in the same way, and existing customers can easily add in the new products. Finally, we're focused on developing and commercializing the new products, in particular that product for the FDA, as well as advancing our other kits. But I'll just close on calling out our next generation 3-base specific instrument that we're developing. This will be a game changer to us. It is a sample to result instrument. The user simply have to load a patient specimen and the instrument does everything. The 3-base conversion, purification, PCR, and reports the results. So this, as I said, will be a game changer. It will certainly give us access to new market segments. So I'll pause there. Tim, the next slide will give you contact details if anyone wants to reach out for additional information, but I'm happy to take questions as time allows.
Right, thanks, John. We've got a few questions. You had sales numbers there. I think you announced 4 million in July, but annual sales of 28 million. Can you give us a little bit of colour? Is that how the road looks forward in terms of revenue?
I guess everybody's looking at what our new normal will be, and it's quite clear from that graph that you can see as we release new products, as we win new customers, you can see that revenue jumping and being maintained because these new customers are generally on contracts. I was pretty clear that the majority of our revenue is from respiratory, it is from enterics, and that's what's been a lot of that. The new products as they come through will give us more products to sell. But we do anticipate that as COVID testing comes down and shifts to a more broader screen, that we are very well positioned for the new customers that we've gained to now offer them the additional tests, which will cover off many more additional targets than what they're currently screening.
There's a good question here. Interested to hear how genetic signatures will compete again on the many fronts where fast testing is coming into play. It's certainly something we're hearing a lot more about.
Look, I'm not sure what the question, if they mean fast screening is in antigen testing. Certainly for a molecular PCR test, the new instrument, we're targeting to do hundreds of patient samples within 3 hours or less, and that's hundreds of samples. So if we're referring to the antigen-based tests, which are quite quick, 15 minutes, they're generally going to be single test only. Do you have COVID, yes or no? We know that the sensitivity isn't the same as PCR tests, the type of test that Genetic Signatures manufactures, but importantly, it's only looking for that one target. And the market is shifting, to test for many other infectious diseases that they've been overlooked during the pandemic. So I'm certainly looking forward to the time where we go back to asymptomatic patients get screened for more than 10, more than 15 targets, including COVID-19 in a 3-hour window, certainly doing hundreds of patients at the same time.
And can you give us a little bit more detail about your current US customers and kind of your plans for the US?
Yeah, look, Tim, we were pleased that the pandemic gave us opened some doors for us in the US, where we are now selling that SARS-CoV-2 product into the US that's in use every day with our customer labs. But the reason I dwelled on that enteric protozoan is, FDA clearance is the game that is the end game for us. That will be only one product, enteric protozoan, and you saw the type of revenue that we hope to achieve with that. So the plan in the US is to keep putting new products through the FDA clearance process. Now, we haven't announced to the market what those products are yet for competitive reasons, but we will in due course.
And obviously, given the times, there's lots of questions around the COVID test kit. Can you give us a little bit of colour on that? Is that something the Australian government would support in terms of using it?
Oh, look, our COVID test kit's in use in Australia every day. It's hard to tell you what our percentage market share is for various reasons, because they tend to pull patient samples into the one test, but I'm confident that we're at least 10% of the market in Australia. I suspect it's higher, but that's at least 10% of market share.
Great, John. That's all we have time for, unfortunately. There's a lot of questions here. I'm not sure whether you want to answer those online if you have time. Otherwise, I'll shoot those through to you on next week.
Sure. Thanks, Tim.
Thank you. Next up, we have Layby. We welcome back Layby, ASX code LBY. It's got a market cap of around 150 million. The company, of course, is a fast-growing buy now, pay later provider with a market-leading positions in New Zealand and the UK and a growing presence in Australia. We welcome back their Managing Director, Gary Roloff. Gary, good to see you. Over to you.
Hi, Tim, and thanks very much for having me back on ShareCafe. It's a pleasure to be here. For those of you who I haven't met before, I'm a co-founder and managing director of Layby. We founded this company, my wife and I, our two boys, back in late 2016. Since that time, we have grown rapidly, and you can see on the screen in front of you now our Q1 FY22 performance highlights. And the numbers we're most proud of, obviously, is the fact that we continue to grow across all parts of our business. We are annualizing 740 million New Zealand dollars. Our revenue for the quarter was 10.4 million. And our GMV for the UK, the growth engine of our business, up 107% on the same quarter prior year. One of the key metrics for us, obviously, is net transaction margin, and at 2%, that is about where we want to be. It demonstrates we have defaults, etc., under control, and we're opening the funnel wide enough to let through enough customers to grow beyond our current 830,000 active customers, as you'll see on the screen. Our active merchants is well through 10,500 now, given this is a little old as at 30 June. And of course, you will be aware, or some of you will be aware, we raised 40 million in capital recently to help fuel that growth in the UK. If you could just go to the next slide, please, Tim. This slide just shows us the record GMV delivered in Q1, greater than what we delivered pre-Christmas or in the lead up to Christmas last year. And the other slides just demonstrating the continued growth across all metrics. If we could go to the next slide, please. This one here just shows our revenue momentum. That too is all tracking the way we want to see it. And the net income graph down the bottom there showing how we have recovered from those early days in the UK where we suffered from fraud, and now we've put those well behind us and are generating that net transaction margin at the 2% level. Next slide, please. Just a little bit of financial information on these slides. I won't go into detail here, but what I would point to is the UK numbers. The UK showing 107% uplift in GMV, 143% uplift in active customers to just over 515,000, and an active merchant number in the UK up 424%. Also of note in that UK, which again is our growth engine, our repeat customers are up from the same quarter last year from 56% to 62%. So we are definitely showing an embracement, if you like, of lay-by in that UK market. Next slide, please. The regional performance, the UK just demonstrated there, showing how we are growing in some of the brands. The next slide, please. And not to be forgotten, Australia and New Zealand, we continue to grow in this market. And we're actually starting to put on more of the recognised brands in the Australian market as lay-by gains more recognition in that space as well. So we're pleased to say that we continue to grow across both Australia and New Zealand, and we are certainly making more of an impact in the Australian market as the weeks and months go by. Next slide, please. From a strategy and outlook perspective, this is really important for us in terms of some of the brands we're bringing on across our territories, but more importantly, if we go to the next slide, this is the affiliate marketing program that we'll roll out later this month, early next. And what the affiliate marketing program will do is increase our merchant base in the UK by around 5,000 merchants between now and the end of the financial year 31 March. So if you think we've got somewhere around 3,000 active merchants in the UK today, that number will go to 8,000 active merchants or more by March 2022. Our goal is to ensure all these new retailers that we bring onto the platform through the affiliate program are activated via purchases with our customers. It's a very easy process for our customers to purchase. We actually inject a virtual card into the checkout, and customers can then pay, if we go to the next slide, by lay-by at some of these iconic brands. Then some of these obviously are global, Amazon, Net-a-Porter, eBay, Shoe, Matches Fashions, Estee Lauder, all brands that many people will be very familiar with, and our customers will now have access to these brands and be able to pay by lay-by. Next slide, please. I've talked before about the size of the retail market and the fact that we have grown considerably over the period we have been there. The point of sale financing in the UK accounts for about 4% of all retail sales made online in 2020. So there is a long, long runway ahead for lay-by in the UK. We've carved ourselves out a position as the known third player in that market, with Klarna and ClearPay being 1 and 2 respectively, and Daylight between us and Fourth, Fifth, etc. So Lay-by is well positioned in the UK, and we continue to grow there. If we just go to the next slide, please. This gives you a sense of the size of the prize in the UK. I think it's underestimated just how big the UK retail market is, at £403 billion, that is. So we're looking forward to continuing our growth here, and the UK is squarely our growth focus for the foreseeable future. Next slide, please. Our outlook for 22, we're still on track to achieve a New Zealand $1 billion in GMV this year. We're still on track to improve our income growth from last year's 34 million by 90 to 100%. And we will continue to improve our net transaction margin as we watch those repeat customers grow. So we've got a lot to look forward to in FY22, some great brands that we're bringing on, and very happy to be able to see that roll out towards the end of this month. Go to the next slide, please. And that's it from me. I'd like to just take any questions, Tim, and hope we can answer all those for you too.
Great, thanks, Gary. Short and sweet, and to the point, thank you. Gary, obviously, the sector has suffered in terms of share prices up until the Afterpay acquisition by Square. Can you give us a little bit more colour on your thoughts about that acquisition and what that means perhaps for further consolidation in the sector?
Yeah, sure, Tim. I mean, what a fantastic outcome for the guys at Afterpay, and good luck to them, and well done in my view. Look, I think if anybody was commenting that buy now, pay later is just a fad, I think they'd have to recognise that it's no longer a fad. This is here to stay. You don't pay 29 billion US on a whim. And what I think it does is validates the sector. I think it starts the conversation around consolidation. And I'm looking forward to seeing what happens in the next short while. I think it gets really, really interesting very quickly.
And Gary, can you give us a little bit more colour on the affiliate marketing program? You seem to have kind of connected with another 5,000 retailers very quickly. Can you tell us how that works in practice?
Yeah, sure. So Tim, we partnered with Sovereign, Rakuten, and a firm called Awin, and they are affiliate marketing platforms. And essentially through them, we gain access to the retailers that are part of their affiliate marketing program. When a customer pays by lay-by at those retailers, having come through our app or our website, we gain a commission on every sale. So it's a pretty simple formula. Our role is to drive customers to our app, to our website, and shop through Lay-by's platform onto those retailers like ASOS, etc.
And in regards to the business model, the retailer obviously pays. Has there been any squeeze on margins in terms of what you paid or Afterpay or any of the competitors from the retailers in that perspective?
No, not really. I think the reality is the value we're bringing to retailers via the customer database we have, the average order value uplift they are receiving, and the conversion improvement they are getting justifies the very small commissions they're paying to us and others for that service.
And you've obviously got a contract with Man City in terms of being able to sell their merchandise with Lay-by. There's a frustrated user here who's a Liverpool fan. Are you working your way through the EPL clubs?
Yeah, look, we've got Man City, Man U, Arsenal, and a handful of other clubs. I'd certainly love to get Liverpool on board. So if the frustrated user would like to introduce me to someone he knows in Liverpool, I'll certainly get hold of them. No problem.
And can you give us a little bit more colour or insight into the top three players? You're at number 3 there. What's it take to become a dominant player in the UK and get that number 1 mantle potentially?
Oh, look, I'm not going to sit here and try and fool anyone. The number 1's Klarna by a country mile. You know, they've been there 16 years. They've carved out a pretty formidable first place position. But the reality is the penetration of buy now, pay later in the UK, as I alluded, is only around 4%. There's a heck of a runway there available for all of us. And for Lay-by, you know, we've been active in the UK for 2.5 years. We've now carved out that third position. Our goal is to continue to cement that and start to take more of a share out of Klarna and ClearPay as we do it.
And what do you think of the Australian market at the moment in regards to buy now, pay later?
Oh, look, it's a Red Sea of competition, which is great because, I don't think many people in Australia wouldn't have heard of buy now, pay later. So that's a good thing. They don't have to ask what we do. And, we've got a great base in Australia and we're continuing to grow there. We're continuing to support our New Zealand merchants who ship or have a presence in Australia. But we also offer great value to Australian retailers who ship or have a presence in New Zealand because we're alongside Afterpay as the dominant two players in the New Zealand market.
And what sort of penetration do you see in Australia? I think you said the UK was 4%, but where's Australia at the moment?
Oh gosh, I think the last stats I read about buy now, pay later penetration online was at about 17%. But as a total accessible market, I would imagine that percentage is less than half that, given the size of the bricks and mortar retail market in Australia.
And in the US, I mean, given that Afterpay transaction, where's the penetration there in terms of percentage?
I think it's still in low percentage terms too, Tim. I mean, what are you talking over there from a total accessible market? Trillions? Yeah, it's very low. And I think that's part of the myth busting that buy now, pay later is starting to achieve is the runway for what we do is very, very long, and there's a lot of opportunity for players to carve out their own wee niche, and we intend to do that.
I think that's a really good point, given those low percentages in terms of integration into the US economy or the UK. There's a lot of upside there for many different players. Can you give us a timeline in terms of what you're looking forward to before the end of the year?
Yeah, look, I'm really looking forward to the affiliate program, obviously, because that really opens up a world of retailers for our consumers to shop with. And I'm looking forward to rolling out our tap to pay solution with some more grunt behind that between now and Christmas and the lead up to peak. It's going well. We just want to turbocharge that as the Brits come back from holiday and start to look at shopping in the high street. So we're looking forward to it. It'll be exciting for us.
Great, Gary. That's all we have time for. Great to have you back and have a nice weekend.
Thanks, Tim. You too. Always a pleasure being on ShareCafe. Thank you. Bye now.
See you again. Bye. Next up, we have Propel Holdings, ASX code PHL, market cap of around $12 million. The company was listed just back in April this year. The company has an open API-driven platform which combines lending products and payment types into one intelligent solution. We have with us the CEO, Michael Davidson. Michael, g'day. Over to you. Thank you.
Thanks, Tim. Thanks for being here. So I guess first slide, please. Yeah. So who are Propel? We're a digital finance platform for small business, and we're on a mission to simplify and open up access to finance to those small businesses. We offer a tailored finance solution to help SMEs manage and optimize their finances with products including business insights, lending, and payments. And we've built our platform to digitize the process, capturing and connecting extensive customer data that then allows us to automate their journey from sign up through assessment right through to onboarding and delivery. As Tim mentioned, we completed an IPO recently on the 14th of April, raising 5 million, and you can find us on the ticker PHL. Next slide, please. Now, just for the key points about what you need to know about Propel and our segment and performance to date. In just 4 months since listing, we've delivered some pretty fantastic results, growing customers on the platform by more than 200% and lending by more than 145%. We've also seen performance continue into the new year with really positive July results announced recently. We've delivered multiple platform and product developments on or ahead of schedule, and we have a solid pipeline of further developments and partnerships planned for the quarter and beyond that will continue that momentum. We operate in a really attractive segment of the market in small business. There's more than 2.1 million SMEs in Australia alone. It's important to note there's more than 55 million SMEs just in key Western markets. And I make that comment because it's relevant because the problems they face are the same as the problems experienced by SMEs in Australia. And our approach to solving it is also directly transferable internationally, making it an obvious step in the future. We have a unique proposition with a finance platform that combines both in-house and third-party products. Our recent integration with Zip being most well known of that with third-party. And we have a well-defined strategy for both product and customer growth that's proving itself in the numbers. Now I'll go on to the next slide and the problem we're solving. So I'll tell you a bit about the problems our customers are facing, and it's an area we put a lot of focus into. It's also pretty critical that investors understand these problems and understand why we'll increasingly take business from traditional providers. What's well understood is that running a small business is hard. You usually only have 1 or 2 owners and a few staff. Many of you may have actually experienced that yourself firsthand. What's not as well known though is that they face really specific challenges around managing their finances. And it falls into a few categories. Firstly, they struggle to manage their cash flow. In a lot of cases, they don't understand the relationship between cash flow and profit. They generally have pretty limited finance knowledge and experience. They're specialists at what they do, but rarely does that extend to finance. And they're reluctant to pay a high price for expert guidance, even though they're aware that they still need it. And lastly, they have difficulty accessing products and services. And it comes in 2 forms, really. They either can't access, banks have always seen this segment as being high risk and hard to service, or they're too difficult to access, so read time consuming. Now you put those problems together and the range of tools you see on the right-hand side of this slide aren't being used. Given each product is usually delivered by a single supplier, our time-poor SME operator needs to sign up for, implement and maintain a service with each one individually. And even for the most savvy owner and operator, it's just not practical. And it means that a whole segment of Australian businesses, often the most in need, are missing out on the benefits, and it hurts them and our economy as a whole. And look, this is the gap we see at Propel and the one that we're solving. Next slide, please. So what does the Propel platform offer? So the left-hand side of this slide here is generally pretty well understood. We help SMEs get access to finance products. What's not as well understood is the right-hand side, and specifically how we're using proprietary tech to capture and crunch data to generate new knowledge and insights not previously available. Now, as you saw in the previous slide, covering the problems small businesses have, they need that advice, guidance, and simple and open access to product. But what very few understand is how the current model of servicing is broken, or at least very severely underperforming. Propel's approach is to take that proprietary insight and learning that we've gained from their data and use it to digitize and automate the delivery of the guidance and product access to our customers. And we refer to internally as predictive finance. Meaning in more and more situations, we're essentially giving our customers answers to finance questions before they thought to ask, or access to product before they knew they needed it. And this places Propel as our customers' gateway to finance and will allow us to replace a number of the services and relationships they currently have, be it their broker, advisor, even Google search for the finance product. But even more importantly, we can deliver a service and experience that's far better than any of those can deliver on their own. It's ambitious and technically very challenging, but as you've seen, we're already on the journey and the destination is in reach. Next slide. So you can see there that the insight and the data is really critically important to the business, but equally as important is then how we provide access to the right product, because it closes the loop for the customer, servicing their need, getting access to that end product, but it's also the revenue generation hub for Propel. So today you'll see on the left-hand side here, we're delivering on the core proposition to customers with insights, payments, and lending. In the future though, the core proposition remains the same, but the offerings on the platform will expand really significantly. We'll continue to expand the capabilities of insights and predictive finance. It is and will continue to be a real focus for the business. Lending will see more in-house product with longer term and larger size lines of credit, and also the addition of third-party products with invoice financing and merchant cash advance. Payments will see expansion in really 2 fronts: the types of payments that customers can accept. So think more BNPLs in addition to Zip, and also digital wallets, but also the ways that they can accept payment. So online and in person. And we have some exciting news on that front, which will be landing in the coming month. We also will be adding a Propel branded account and card, so our customers can increasingly essentially live their entire financial life on the platform. Now, just a final piece, an important question that I'm often asked is, do you have to build all of these products in-house? And the short answer is no. There are a lot of great products, as you can see there on the right-hand side, that solve singular problems really well. We'll connect those to the platform whilst continuing to provide that simple and seamless access that our customers come for. And as the platform smarts continue to increase, we're able to guide our customers on which of those products to use and when. Next slide. So that's how we go from where we are now. Here's a little on the timing, and the timing is important because, as I mentioned, with each edition comes an additional revenue stream. Phase 1 was post-IPO, which saw quite a bit of activity, and we delivered a number of products and features. Phase 2 is the coming 12 months and essentially FY22. And it's really significant because it'll bring a number of advances on that business insights front as it evolves its predictive abilities. We'll bring a number of developments on payments and lending. As I mentioned, lending in the coming 12 months, we'll see longer term and larger facilities. On that lending side, we'll actually probably see those products landing within quarter, this Q1, FY22. And as I mentioned, we're also expanding the types of payments and the ways they can accept. And we'll also be seeing a number of deliveries on that front this quarter. The accountant card, we've committed to doing it in the financial year, but we are ideally pushing to have it probably out in calendar year, so before December. Phase 3 is where we take it to the next level and beyond, and that's further developments, and I'll be harping on about this in the future, but further developments with insights, but moving towards a premium subscription model. So as that feature develops real use for our users, we'll start to charge for a premium version of it. Continued expansion for platform connected product will continue, I would imagine, indefinitely, but it's also in this time frame we expect to be seriously progressing international options. Next slide. So just a bit more onto the numbers. I mentioned early some of those key results, and as you can see there's all of these results are actually available in our market updates, and there's been fantastic growth since the IPO, up to and since the IPO. But since IPO, we've really started to accelerate as we started to execute on the plan. Key callouts really relate to our key levers, and there's 2 drivers of the business, and that's customer growth, so customers that are on platform, and also revenue per customer. And I've talked about that from revenue usage, product usage point of view. Customer platform numbers have grown more than 200%, more than doubling, and the lending on the platform more than 145%. But importantly, alongside those increases, we've also seen a steady increase in the quality of the average customer, and that leads to much better product commercials and net revenue at the end of the day. Given the success of the acquisition strategies to date, we foresee continued strong growth for the coming periods. Next slide. So just to sum up the Propel investment opportunity as we see it, we have a unique product and proposition in a chronically underserved segment of the market, demonstrated growth in key metrics with growth on track to continue, and a really solid pipeline of developments and partnerships to support and accelerate that growth. We're in a rapidly growing sector, it's fintech, and it's undergoing a generational shift away from traditional providers. The sector is also receiving a really high level of focus, and rightly so, and we expect that to continue. And based on our current level of progress and the development of the business, we see our valuation compared to our peers as quite attractive. That's it for me. Thanks for your time, and back to you, Tim.
Great, thanks, Michael. Can you just give us a little, because you're only listed back in April, can you give us a little bit of colour around the history, how this came about, and kind of where you're at in terms of revenues? Yeah, so we launched the Propel platform and product in May 2020, actually right in the teeth of COVID and the lockdown. So it was an interesting time to do it. Some would say it's a bad time, but in hindsight, it's probably a very good time because it usually throws up some opportunities. We took the product from there and developed it through the back end of the year. And a lot of the IPO activity happened in conjunction with us growing the platform and the proposition. So it's from its infancy, easy for me to say, mid 2020 through to where it is now. And it's from IPO and onwards that we've really seen that accelerated customer growth as we've been able to invest in the activity to really drive customers on and drive more products and features to the platform. So not a long journey, but definitely a positive one today. And you're essentially a marketplace. I guess so. You've got the small businesses that you have to bring onto the platform, and then you've got the providers of the product. How would I use it as a small business owner? Do I come on it for a lending perspective? Is that where I start and then I build out the use of products? It's a really interesting question. And it is more than a marketplace in so much as
we don't just provide access to the product. So say you're a small business, you may come for lending, you may come because you need to solve a payments problem. But what we've found, and this is really the premise of the product and the platform, is that just throwing money at a is usually a really inefficient way to solve it. And if a business gets professional advice, they're usually told that. But in this segment, they don't seek it out because it's expensive. So what we're doing, more than just providing a platform and access, is we're also giving them that knowledge and guidance around what may come to us for lending. And we'll say, hey, that's great. You can get access to some funds for growth. But in reality, you should just take payments for 50% of your invoices up front, as opposed to going on 14 or 28-day terms. So it's more than just saying, you want a loan, here's a loan. It's actually giving them some guidance and advice around what they should be using. And as we build more product onto the platform, we're able to actually guide them in more intelligent ways. So it's really improving their financial health more than just providing a platform.
And is that difficult to get product providers on the platform when at the same time you're trying to bring clients onto the platform, small businesses?
It's actually not, no. In most cases, as I mentioned, so we do a number in-house ourselves, and then we also plug in third party. And again, I mentioned Zip as an example. In almost all cases, those products are fantastic products by themselves, and they're looking for distribution themselves, and our customers are looking to use them. So pretty much every conversation we've had has been, they're actually quite keen to plug in and serve the need of that customer. Acquiring customers is always a relatively difficult process, but we have found a really efficient way to do it, in that we can digitally target those that are looking specifically for this type of service. So we've been able to find an efficient way to acquire and grow quickly. We'll have some news on that soon on more of a freemium type service that allows them to experience it without having to take a product initially, which we expect to significantly ramp the numbers of customers on platform.
And who pays? What's the business model? That you white label a product at times, or you sell another product essentially? How does Propel get paid?
Yeah, so one of the good things is it's very straightforward. On our current products on platform, on a loan, it's net interest margin, and then on a payments product, it's essentially a clip of the ticket, so a transactional merchant transaction fee. As we bring in, so very simple to understand in that respect, and it is entirely, the customer is not charged anything directly for access to the platform. They only pay on usage. So there's no monthly fees. They can come on the platform and then just use and pay as they need it. As we see, for each additional product that lands, we have an additional revenue stream. And whilst it's an additional stream, in most cases, they'll really be a substream under lending. More lending products will be more net interest margin. And if it's third party, it's usually a shared revenue model. The payment side, again, it's very similar. If it's a BNPL, a buy now, pay later, or a credit card, it's again just a clip of the ticket. A clip of the merchant transaction fee. Importantly, on BNPLs and digital wallets, we generally get higher margins, so we're really keen to pursue that segment.
And who are your competitors in this space at the moment? Is it someone like Society One? And with some of those white label products, do you have any credit risk on at all?
So it depends on the service. So currently we manage our own book for our lending product. So we carry the credit risk against that. We have a really developed and proven credit model to assess and onboard and then maintain. And actually a point around that is we stay connected. We connect to and stay connected to a customer's information. So we see the health of the business change over time, which gives us indications of if something's going bad. On the white labeled side, generally the risk is carried by the third party and we share the revenue. On the competitive front, we often get asked the question, is Square a competitor? Is Society One or Prosper? In most cases, they're generally actually an option for plugging into the platform, because they might provide a product that addresses a certain segment of the market that we don't currently address. We have a line of credit from $0 to $100,000. And Zip Business Finance, for example, I was talking to the Zip team just recently, they have one that goes from 100 to 500. That's absolutely, it's often seen as being a competitor, but in almost all cases, it's usually a business that wants to partner and plug into the platform. Again, because we're that gateway and we're directing them to, it's essentially a trusted advisor relationship with our customers and put them into the right product.
Michael, that's all we have time for. Great to hear
Thanks,
a new
Tim.
story Congratulations on your listing, and we'll get you back on again.
Cheers. Thank you.
Okay, next up we have Bowen Coking Coal, ASX code BCB, market cap of around 170 million, 1 year return of up 188%. The company is Queensland-based coking coal exploration company with advanced exploration assets. We have with us the Executive Chairman, Nick Jorce. Nick, thanks for your time. Over to you.
Yeah, thanks, Tim. Look, great to be here, and thanks to ShareCafe, and what an interesting bunch of speakers you've had today. Quite a diverse mix. So for something different, we're going to talk about junior resources. Look, let me start by saying what we're aiming to achieve. So Bowen is, we've been an explorer. We're moving into development and production, and we're very, very focused on becoming the next significant independent coking coal producer in Queensland's Bowen Basin, targeting over 5 million tonnes a year of production by 2024. So let me just dwell on that for a minute, because it probably goes to a point you made earlier, Tim, in your introductions about ESG and what the responses of different companies are to that. So I guess it's important to distinguish between the types of coal that are produced, and not everybody does that, but we're very focused on metallurgical or coking coal, which goes to produce steel with iron ore. That's a very strong market. That's a growing market, and there's really no world in which that market doesn't continue to grow for the foreseeable future. So we think we're in a great segment. What the ESG sort of dialogue has meant, though, is that a number of the bigger players are leaving the coal sector generally. So there aren't too many of us left to sort of pick up the assets that some of the big guys are offloading. So we are very growth focused, and we're very focused on building a significant business with that opportunity in mind. Just on the target, 5 million tonnes a year, it sounds like a big number. Well, for those of you who aren't in the mining industry or aren't aware of it, that is quite a big number. As I say, there aren't too many listed peers. Coronado is one. They're doing roughly twice that, as a $2 billion, just over $2 billion enterprise value company. So that's certainly our target in the midterm, and now we've got the projects to do that. So let me take you through a little bit of background, and then where we're heading. I guess the company's changed quite significantly in the last couple of weeks. I don't say that lightly, but we've actually been working on these deals, one of them in particular, for over 2 years. But we announced last week the acquisition of a 90% stake in the Burton mine and the Lenton project, which is a high-quality coking coal mine and expansion project in central Queensland. So that includes 5.5 million tonne a year wash plant, a train loadout facility, accommodation village, and it comes with a large Taiwanese joint venture partner as well as a 10% holder of that project. So that's a transformational change for us. We've got a couple other projects I'll talk about, which are a bit smaller, but this is one that fits very well and allows us to get into significant production very quickly. On top of that, we also announced very recently that we are preferred bidder for the Bluff PCI mine. So PCI, another type of coal that goes into the steelmaking process, which is another exciting project. So that is licensed to do up to 1.8 million tonnes a year. We're looking to get that transaction completed and finalised as quickly as we can and get that into production ASAP. So those are the two new things we've done in the last couple of weeks, or announced in the last couple of weeks, but we've got some great projects that sit behind that. Broadmeadow East and Isaac River are two advanced smaller projects, but targeting combined production, ROM production between 1.1 and 1.7 million tonnes a year. Development decision plan for later this year, and final approvals in place at that point. We have a project called Hillalong, which we have 90% of, and Sumitomo, large Japanese conglomerate, is earning up to 20% in by funding our exploration, and then a number of other assets. I might just move to the next slide and talk about the team briefly. So it's a very experienced team, board, and also key management personnel who aren't shown here, but between us, we've opened 11 coal mines and operated more than 25 coal mines worldwide. I'm a relative newcomer to the industry, but my background, I started a company called Stanmore Coal in 2008. We listed in 2009. 2016, we bought an asset called Isaac Plains for $1, and we turned that back on again as a high quality met coal asset, and that's now producing somewhere around 2 million tonnes a year. But I've recently joined, on the last couple of years, I've been working with Gerhard, who started Bowen Coking Coal. Gerhard is the MD, and he's had a long career in the industry, including as Exaro of South Africa as their rep in Australia, looking at picking up projects in the Bowen Basin. So a very experienced guy. Matt Lattimore is one of the best coal marketers around. He's on our board and heavily invested in our company, as are all of our board. Neville Snedden, again, and Blair Sargent, very extensive history in the coal industry. Next slide, please. So in brief, what we've done is we've acquired high quality, long life met coal asset or set of assets. It comes with infrastructure, which has a replacement value of probably north of $300 million. Near-term production, so we're aiming to get the Burton Lenton mine going in around 12 months. And it marries in well with an existing asset we've got nearby. I'll show you on another map, but that's Broadmeadow East. And we're aiming to get that one going in around 6 months or so, subject to securing some third-party infrastructure to export that through. Materially increases our resources, and yeah, it gives us a great hub and a great sort of northern Bowen Basin presence. We did a $15.4 million equity raising. The rights component of that's still underway. That's underwritten. But part of that was a $7 million placement to Brian Flannery, who's a very well-known coal investor and former coal executive. Thanks. Next slide, please. Yeah, look, I'll just skip through this pretty quickly, but we've got this Burton Lenton asset is on care and maintenance at the moment. It's open pit, although there is some extensions and underground extensions that we'll target as well. But it's a pretty simple operation as an open pit. As I said, very large amount of infrastructure comes with the deal. Yeah, targeting mainly a high quality coking coal. Granted mining lease, we need to do a little bit more work. We've got an EA, environmental authority, but we need to do a little bit more work on a final void plan before we start mining this. And Lenton sits up to the north there, which is an undeveloped open pit resource, which will feed through the same infrastructure. Next slide, please. So this picture just gives you a sense of where it sits in the Bowen Basin, right in the heart of the northern Bowen Basin. Some of the best quality met coal in the world gets exported out of here. Right near our Broadmeadow East project, which used to form part of this whole Burton complex and now will again. So we'll feed all of that through the same infrastructure once we get that tidied up. Next slide, please. As well as being very close to Broadmeadow East, it's also close to a number of other projects, including Hillalong, which is potentially quite a large open cut met coal project, and we can potentially feed that through the same infrastructure as well. Hillalong is the one where Sumitomo is farming into, spending the money on exploration there. We've recently hit about 9 metre seam and about 32 metres of very high quality coking coal. So we're very excited about what that could turn into and could feed in some additional tonnes through this. Cabra is another small project which also will feed potentially through this infrastructure. Next slide, please. Yeah, so look, it's a great fit for us. Primarily coking coal, great part of the world, ready for production, transforms us into a significant producer and really sort of accelerates that journey for us. The coal itself is well known in the market, 18-year historic production, very high quality met coal. Next slide, please. Look, just some snapshot of our other assets. Bluff, you can maybe see if you've got a good eye down the bottom there, is in the southern part of the Bowen Basin. We'll go to Gladstone, and we're building a nice hub down there as well with some other assets. And our other focus is the northern hub with now Burton, Lenton, Broadmeadow East, etc. Next slide, please. So here's the metrics of what we're trying to achieve over the next 2 or 3 years, is build this up to steady state production. running around 5 million tonnes of ROM and about just up towards 4 million tonnes of product. That's before we consider anything out of Bluff or anything that may come out of Hillelong. So, that really does propel us into a pretty significant kind of production territory. The FOB costs are reasonably standard for that part of the basin, sort of north of 100, 120, 110 Aussies, plus royalties. We'll come to coal price in a minute, but hard coking coal sitting over 200 US at the moment, so the margins are very high, and this will, at current prices, this set of assets will throw up an awful lot of cash. Next slide, please. Look, I'll skip through this one in the interest of time. Let's perhaps head to the next slide. Yeah, so the development schedule, Broadmeadow East and Isaac River are some 6 months away, subject to final approvals and accessing third-party infrastructure. And then sitting now closely behind that are Burton, Lenton, which will, we're targeting within 12 months to get them going. And Hillelong sits behind that, and then our big Karura, big underground, is another one that we'll look to fund out of some of the cash flows we get from these early ones. Next slide, please. Just briefly on coal prices, I mean, a lot of conjecture about coal industry being dead. This will tell you it's far from the truth. Chinese coking coal sitting over 300 US. Steel price is very strong as well. Aussie Bowen Basin coking coal, prime low vol sitting at 220 or so US. Thermal very high, 150 or north. PCI similarly very high. So we're very excited about turning on these assets at a good time in the met coal market. Probably call it quits there, Tim, and see if anyone's got any questions.
Got my glasses on, Nick. Obviously, you've got a very strong commodity price and the coal price, a bit like the oil market, right? You've got charging commodity prices and some serious challenges in the industry. How do you see the future of coal playing out?
Yeah, look, I'm clearly very bullish on it, but I don't say that lightly. I mean, I think if you look at all the reputable commentators, the forecast for the steel industry is substantial growth through to now in 2050, when everybody's talking about being net neutral in a CO2 sense. You're still talking about, I think the International Energy Agency is talking about a 30% increase in steel production by that time. And met coal will play a very big role in that. At the moment, about 70% of steel is made from coking coal. The balance is recycled steel, and that's really capped out because that's 80-90% of steel is recycled, and it's capped by the fact that in the last 40 or so years, steel demand has tripled. So even if you kind of scrap everything that's 40 or 50 years up, you're only going to get to 30%, which is about where we're at the moment. There's talk of other technologies, hydrogen, direct reduction. That's got some real challenges, and happy to chat through that as well. I'm not saying it's not something that we're kind of keeping an eye on, but absolutely, we're very bullish on met coal into the future. And I think the other point to make is that you can't build any of this, renewables or any of this stuff without steel. And at the moment, you can't build steel without met coal.
Yeah, good point there. Now, there's a question here on what are the best sources of funding to maintain a project's momentum? Does being an aggregator of coal assets make accessing funding easier?
Yeah, look, I think it does, and I think a bit of track record helps it as well. We've got reasonable access to capital as we need it. Certainly not as sort of as much as there used to be. But look, I think the listed market's still a good place to play. I mean, we've had a decent response to our acquisitions there. For equity and for debt, there's a number of sources. Some of the traditional Aussie banks are less playing now, but there's certainly international funds around that will still play in that space. So I guess this is what we do. We've kind of had a track record of doing this and finding the money for the right deals, and we'll continue to do that.
And obviously, you're just in the process of bedding down an acquisition, but is acquiring and consolidating, bringing these assets under one brand part of the strategy? And do you see those assets being kind of mispriced at the moment?
Look, I do. I think it's a great point. I think these things are changing hands probably too cheaply, and we'll look back at this and think, this was a once in a generation opportunity to pick up some of the prime assets in the Bowen Basin. You've got the big guys like BHP are running a process to sell their BMC assets in the Bowen Basin at the moment. And there's not a lot of buyers, and people are just getting out for, for ESG or philosophical reasons, I guess. So yeah, look, we think it's a tremendous opportunity. It's part of our DNA is to grow and to acquire. We obviously need to execute well on these, turning these things on and bed these down, and we'll do that. We've got the right team to do that. But we're continuing to look and continuing, given the opportunity that sits there at the moment for us, we're continuing to look at and run the rule over things.
And politically, it's obviously an industry very well supported in Australia. Is there any trends you're seeing offshore that it means that the coal industry is going to be around and well supported by governments moving forward as well?
Yeah, I do think that you're seeing some jurisdictions are kind of less keen on it for various reasons, but you're seeing some of the Canadian projects struggle, New Zealand, other places where there's a bit of political heat. I think the reality is, we're such a big part of the Queensland economy, the Bowen Basin and the Australian economy, with sort of $4 billion of royalties or north every year and an awful lot of taxes and employment, that by definition we have to be taken seriously. And look, and I think the Queensland government and the federal government, all levels of government, to be frank, have got their head around the industry and understand why they should back it, and that we're part of the solution here, not part of the problem.
And moving forward, what should shareholders look out for over the next 12 months or so from Bowen?
Look, I think there'll be some more milestones around kind of completing these acquisitions, early, more milestones around final approvals and getting into early coal. There'll be a lot of news flow around all of that. As I say, we are still looking at a number of other opportunities and heading for cash flow. That's really the key. At the end of the day, cash is king, and you don't have to be a magician to sort of work the maths on 5 million tonnes a year, making a margin of, I'm not in the forecasting game today, but let's say with coal prices where they are, north of $60 or $80 a tonne, is going to become a cash machine. So I think that's going to be the driver of the value in the long term. Great,
Nick, that's all we have time for. Enjoy your weekend. I'm assuming you're out of lockdown up there, so enjoy your freedom while you can.
Not me. I'm in quarantine. But I'm out tonight, so yeah.
Good luck.
Thank you. Thanks, Tim.
Okay, see you again. Thank you.
Thanks.
That's all we have time for today. Have an enjoyable weekend wherever you are, and we'll see you again next week.